How can I lock in today's $13.6 million estate tax exemption before it disappears in 2026? Imagine for a moment that you've dedicated a lifetime to building something truly significant. Perhaps a successful business, a cherished real estate portfolio, or a carefully nurtured investment fund. You've built a financial legacy, a testament to your hard work and vision. Now, picture a gatekeeper standing between your beloved family and the fruits of your lifelong labor, ready to levy a substantial toll. This gatekeeper is the federal estate tax. Right now, that gate is remarkably wide open. We are in a golden era, where you can transfer a staggering $13.6 million per individual. That's nearly $27.2 million for a married couple, completely free from federal estate taxes. This is your estate tax exemption amount, your personal allowance for passing wealth to the next generation without that heavy government toll. But here's the crucial detail, the ticking clock. This generous gate is scheduled to narrow dramatically at the end of 2025. It's set to snap back to roughly half its current size in 2026, adjusted for inflation, unless Congress intervenes. This isn't just a minor adjustment. It's a monumental shift that could expose millions of your taxable assets to a 40% federal estate tax. Think of it like this. You've been granted a limited time opportunity to fill a very large bucket with your generational wealth before that bucket shrinks by half. If you don't fill it now, any overflow might just be siphoned away by taxes. The question is, how do you seize this moment? How can you effectively lock in today's incredible estate tax exclusion amount before it disappears? That's precisely what we're going to explore together. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this valuable information. Now let's continue. Part 1. Understanding the estate tax landscape and its looming change. Let's clarify what we're up against. The federal estate tax is essentially a tax on your right to transfer property at your death. It's imposed on the value of your entire gross estate. That's all your assets, from real estate and investments to retirement accounts and life insurance. Currently, if the total value of your estate exceeds that $13.6 million exemption, anything above that amount is subject to a hefty 40% tax rate. For high net worth individuals, this can mean millions of dollars in taxes that could otherwise go to your children, grandchildren, or the charitable causes you care about. The reason for this looming change in 2026 stems from a provision within the Tax Cuts and Jobs Act of 2017. This legislation temporarily doubled the estate tax exemption, creating the elevated levels we enjoy today. However, this provision has a built-in sunset clause. Without new legislation, it will revert to its pre-2018 levels, adjusted for inflation. This reversion means a significant reduction, likely bringing the individual exemption down to somewhere in the $7 million range. So, if your financial legacy is valued at, say, $15 million today, it's currently exempt. But come 2026, nearly half of that, perhaps $8 million, could become taxable assets if no action is taken. This is why proactive tax management is so vital right now. Part 2. Let's talk about the power of lifetime gifting. One of the most powerful tools at your disposal to take advantage of the current high estate tax exemption is lifetime gifting. This involves transferring assets out of your estate during your lifetime. When you make a gift, you use up a portion of your lifetime gift tax exemption, which is unified with the estate tax exemption. What this means is that every dollar you gift during your life reduces the amount that can be passed tax-free at your death. By making substantial gifts now, you are effectively using up your large current exemption before it shrinks. Think of it as prepaying for your future estate tax benefits. For example, if you gift $5 million to your children today, that amount reduces your available estate tax exemption at death by $5 million. If you wait until 2026 and the exemption drops, that same $5 million gift would consume a much larger percentage of the then smaller exemption, or even become subject to tax if it exceeds the new limit. It's truly a use it or lose it scenario for a portion of your wealth transfer capacity. Beyond this, remember the annual gift tax exclusion. For 2025, you can give $19,000 to as many individuals as you wish, tax-free, without dipping into your lifetime exemption at all. A married couple can effectively gift $38,000 to each recipient. This is an excellent, simple way to begin transferring family wealth over time, reducing your gross estate year by year. Though for very large estates, it's only a small piece of the puzzle. The real impact comes from leveraging that much larger lifetime exemption. Part 3. Leveraging specialized trusts for strategic gifting. While direct lifetime gifts are effective, for those with complex or very large estates, specialized irrevocable trusts offer sophisticated ways to maximize the current exemption and achieve specific estate planning goals. Once assets are placed into an irrevocable trust, they are generally removed from your taxable estate, meaning any future appreciation of those assets also grows outside your estate, further reducing your future estate tax liability. Let's explore a few key types. First, consider a spousal lifetime access trust, often called a SLAT. This is a powerful tool for married couples. One spouse creates an irrevocable trust for the benefit of the other spouse, and often their children. The beneficiary spouse can access funds from the trust for their health, education, maintenance, and support. This allows the gifting spouse to use a portion of their lifetime gift tax exemption to fund the trust, removing the assets from their estate, while still maintaining indirect access to the funds through their spouse. It's an excellent way to use both spouses' exemptions, providing a vital safety net while making a significant wealth transfer. Then, there's the Grantor Retained Annuity Trust, or GRAT. This strategy allows you to transfer appreciating assets, like shares in a growing business or valuable real estate, out of your estate with minimal or no gift tax. You transfer the asset to the GRAT, and in return, the trust pays you an annuity for a set period. At the end of that period, any remaining value in the trust, particularly if the assets have grown significantly, passes to your beneficiaries free of further gift or estate tax. It's an elegant way to freeze the value of highly appreciating assets for estate tax purposes. Another sophisticated option is the Intentionally Defective Grantor Trust, or IDGT. This might sound a bit unusual, but it's a perfectly legitimate and powerful estate tax planning tool. With an IDGT, you sell assets to the trust in exchange for a promissory note. The defective part means that for income tax purposes, you, the grantor, are still considered the owner of the trust assets, so you pay the income taxes. However, for estate tax purposes, the assets are out of your estate. This allows the assets to grow tax-free within the trust, outside your estate, while you continue to pay the income taxes, effectively reducing your estate further without incurring additional gift tax. It's a high-level wealth transfer technique designed to minimize estate tax liability. Finally, for many high-net-worth individuals, irrevocable life insurance trusts, or ILITs, are a cornerstone of estate planning. If you own a life insurance policy personally, its death benefit is included in your taxable estate. By transferring ownership of the policy to an ILIT, the death benefit can be completely excluded from your estate. This means the proceeds can provide tax-free liquidity to your heirs, often used to cover estate taxes, or provide immediate cash without adding to the tax burden of your estate. It's a fantastic tool for wealth preservation and ensuring your financial legacy is passed on efficiently. Part 4. Holistic Estate Planning and the Path Forward. As you can hear, these estate tax planning strategies are intricate. They require careful consideration of your entire financial picture, including your investment strategies, your retirement income planning, and your charitable giving goals. The goal isn't just to avoid taxes. It's to align your estate plan with your deepest values and ensure your family wealth is managed according to your wishes. The impending change in the federal estate tax exemption in 2026 presents a unique window of opportunity. It's a rare chance to make significant wealth transfers under the most favorable tax rules we've seen in a long time. However, the complexity of these strategies, from understanding the nuances of various trust structures to navigating the implications for your overall financial planning, means this isn't a do-it-yourself project. Navigating these waters requires the expertise of seasoned professionals. An experienced estate planning attorney can draft the necessary documents and ensure legal compliance. A knowledgeable financial advisor can help you assess your total financial assets, integrate these strategies into your broader wealth management plan, and ensure that your financial independence is protected for future generations. These professionals work hand in hand to build a robust succession plan that truly secures your financial future. This journey, while detailed, is ultimately about empowerment. It's about taking control, ensuring that your hard-earned generational wealth benefits those you intend, rather than being diminished by avoidable taxes. Don't let this historic opportunity slip away. The time to act, to discuss these possibilities and to put a solid estate plan in place, is now, before that window of opportunity begins to close at the end of 2025. Part 5. Your next step. Secure your legacy. So, if you're listening and you realize the potential impact of these upcoming estate tax law changes on your financial legacy, what's your next step? The most critical action you can take is to connect with a qualified financial advisor specializing in estate planning for high-net-worth individuals. Seek out an advisor who truly understands the intricacies of estate tax minimization and can craft a personalized strategy that fits your unique circumstances and aspirations. This is about securing your family wealth and ensuring your intentions are carried out effectively. Don't procrastinate. This is a time-sensitive opportunity that can save your retirement savings and your family a substantial amount of money. Take the time to understand your options and act decisively. Your financial future and the wealth preservation of your generational wealth depend on it. If you found this discussion illuminating and empowering, please do me a favor. Hit that like button. It truly helps us bring more vital financial advice to those who need it. Subscribe to this channel for ongoing insights into investment strategies, tax planning, and retirement tips that can impact your life and your legacy. And finally, please comment below with any questions you have about estate taxes, trusts, or wealth transfer techniques. Your questions help us create content that truly serves your needs. Thank you for joining me today. Take action, secure your legacy, and build the financial future you envision.